There are expectations already, of course, baked in for that March meeting. Does the strength that we saw in that unexpected jobs print, plus the expectation of a further rise in the CPI number this week, add to the argument that they need to be even more aggressive?
Well, first, I'd go back to that strong number. While certainly the raw data did show that the economy shook off Omicron much more than I think many had feared, it was a truly unfortunate time for a regularly scheduled data recalibration by the BLS. And so, what we don't know looking at that data really is, does this strong job growth, is this a trend? Is this showing a growth trend, or is this just that we overcorrected for Omicron, and that is the reason we're seeing this strong growth? So from our perspective at Bain, we're more neutral on this. All that said, it does put the Fed in a very tricky spot in terms of what it can do as it's managing between two. It's got its dual mandate, and not by that we mean not just price stability and unemployment, but trying to manage the real economy where we see that hot inflation, and the financial economy, which quivers every time we talk about rate rises.
The distortions that you talk about, it points to a broader problem for global central banks, right? We're expecting more than half of the global economy to have tightened monetary conditions by April this year. That's according to JP Morgan. How much risk is there of a policy overstep given all of the dislocations that we know with this COVID-related slowdown?
Well, that's precisely the challenge. If we look at the real economy in the U.S., we see that nominal growth in Q4 was 12% year over year versus a Fed fund rate of 0%. That is the largest gap we've seen between those two figures since the 1950s. Now, the inflation that's coming on the real economy, where goods and services and where we live on a day-to-day basis, is driven in large part, of course, by the supply chain snarls and policies coming out of COVID, which is a step removed from the Fed's mandate. On the other hand, whenever we see a discussion about rates rising, for example, if we look back to January, the VIX popped over 30 on the 25th of January. And so we have, on the one hand, the need for a pretty aggressive rate rise. On the other hand, the smallest pin possible to prick the balloon in financial markets. And I think that puts the Fed in a really tricky position.
And they've really tried very hard to be very transparent, to really tell the markets where they're headed, right? But I wonder if that also risks causing more uncertainty and volatility in the markets because, of course, traders are getting ahead of what the Fed will do at the same time.
Yeah, it's a great point. We look at the transparency. Back in the Greenspan days, everyone would be looking at the TV to see how fat his portfolio was to try to guess which direction rates were moving in. Now, today, we have so much transparency that it's almost like a hall of mirrors where the markets guess what the Fed's doing, guess what the market's doing. And at some point, we're a little bit concerned that the markets aren't going to carry the water for the Fed anymore, and that instead that transparency will actually create more volatility than one would have thought with a policy like that.
Karen, in an economy like China, where they seem to be going against the global trend of tightening and instead they're signaling more easing in terms of monetary and fiscal policy, what do you keep an eye on for potential risks?
Right. So China came out of the pandemic with a growth trajectory that's notably flatter than going into it. Now, some of this is part of the policy. When they talk about a common prosperity and quality growth, those are all signals that we're no longer looking at a China that's trying to hit a high watermark on growth, and much more one that is interested in, as we've heard, distribution of those gains, the olive-shaped economy. All of that said, what's happening in the property market is a bit tricky. We have the growth rates of 6% aren't attainable in a world where the construction sector is contracting. And so I think there's a real question about how policy manages that sector, which, though we're all distracted with the Olympics right now, is still experiencing some real pressure, and how that plays into growth coming through this next year.